Hey, good morning, everyone. Marty Missouri here. Friday, April 2nd, 2021. Happy Good Friday to you all out there. I just completed the weekly macro update, part of our lengthy weekly analyses. And, typically I write you a macro update on the blog. This time I thought I'd just, and I promise quickly, but you know me, give it to you via video today. I've been trying to wait out my neighbor across the street. He has quite the project going on. Look at out there. He's cutting down limbs and putting them in mulch and putting them in a mulch machine. And I think he's going to win. So if you can hear that in the background, I think you'll hear me over it. I don't think it's too bad, or it shouldn't be through the microphone. But anyway, again, I want to really focus just on the macro today. There's so much on the market that is happening below the surface, but we'll save that for the written blog or maybe future videos. So I'm going to run through a few things, make some comments, going to keep it economically oriented. In front of you, I just cut and paste the latest from the PWA index. That's what I just scored. Really big jump today. We jumped 8 points to just over 18. And that, I'm going to get my drawing tool here, that you can see right there. That's a really nice move. You got to go back to, I think July or so, back here in 2019. So almost 2 years, kind of catching up. We peaked way back toward the beginning of 2018. And then we got cautious using a collar, doing some hedging in here. And then we began changing up the portfolio in December. That's where we started adding gold and other things. And then in here, where our thesis really evolved into something that continued to acknowledge the debt bubble that lies beneath, that would be epic if it is to get pure. Started to here, made great sense, but the Fed did some things that, well, we talked about it, but technically illegal with the Fed printing money and buying securities, but that's what they did. And that has kind of kept, things looking better. Although this is the macro, this is 49 indicators. A lot of this has to do with just a continual pump of stimulus into the economy. As for the markets, which we're not going to focus on too much, particularly the equity markets, it's just keeping interest rates really at below zero when you adjust for inflation and forcing people out the risk curve. So, stocks do well when people are awash in money, and, stocks have been going up for 12 years. So that's a precarious situation, you probably could imagine. Of course, if you've been listening to me for the last couple of years, you know what I'm talking about. So that's that, and that's good. So good move in the index. The globally, things are really looking up. We just pretty much are through all of the global purchasing managers indexes, and wow. Now this is a month-over-month read, but this is really, really good. I know, with the exception, you got to get down here to Malaysia, and then of course we have utter human catastrophes going on in Myanmar. But Malaysia and Thailand are still in contraction mode. Virtually all the other major economies are robustly in growth mode. I say robustly. Down here at the bottom, China's actually been coming down a bit, as has Russia. And again, above 50 means month over month, we're seeing the economy grow. You start getting up here at 66, 67, and it was this morning's or yesterday morning's Institute for Supply Management Index for manufacturing for the U.S. was like 67. I think I've got that loaded up for you here in a second. So big deal. And so a lot of pressure on manufacturing. I've been sharing with you the results of the survey questions, and while they're optimistic, they are fighting through a mess of bottlenecks, really high prices in terms of the inputs, passing that through to consumers. The Fed says it's transient, no worries about inflation. Lots of really smart economists say the same thing. I've been expressing my thoughts a lot herein, and I think that's on the wrong side of the potential for inflation and the potential problematicness of inflation going forward. But again, that's just one person's opinion. I think what we're doing in the portfolios, though, makes great sense, even without rampant inflation. Certainly takes advantage of it, but it also takes advantage of the other scenario, which is a more pessimistic scenario, um, in many dimensions in terms of what we're doing. Okay, so let me get rid of that, and I will take you through some of the other stuff that I want you to see, start to finish. So we had three indicators improve in terms of our score, three inputs into our macro index, and nothing declined, and one indicator actually jumped two spots, and I think that was auto sales, which is the one we have right up here. And so that's a 4 net points, which is why we got the big jump of 8 points in the overall index. So auto sales, they went from negative right here to really positive. So a big jump in auto sales. A young man I play basketball with sells cars, and I haven't talked to him in a while, but I was asking him when those stimulus checks are coming, what happens? He said, "Oh my gosh, we just get a rush. I mean, those are down payments on new cars." So we know we just got stimulus payments. So again, that's where we've got to put all this into context. But on the index, I got to score it like I see it. That's a nice jump. We're getting back here at some pretty good levels, or threatening to. So that's very optimistic for the economy. Consumer confidence, that's been somewhat of a negative, but yes, definitely. Consumer is feeling better. So we've got some good trends. And finally, this last week, we finally got a nice move in the Conference Board's economic indicator. The Bloomberg's weekly, these two are monthly. And I say economic indicator, consumer confidence. So we are a long ways from, our pre-COVID levels, of course. But that is good, and that is an uptrend. Higher lows and a new higher high, right? Just barely there, but hugely there. So consumers looking up, that means, when the consumer's feeling good, they're probably going to spend some money, and we need to account for that accurately in our index. The commercial and industrial loans, I guess that's going to be PPP, right? We got a new round of that, but that had been really, really negative after that, just that monster jump, right, that we got right here, with the advent of COVID. This is unusual, right? Usually economies, fall out of bed, and these are recessions back here, by the way. And you see downward movements. This is just so unique. We just had a blip and then through the roof, because the powers that be have zero stomach for the economic cycle, or at least the part that they don't like. And that has certainly long-term implications that we need to be very sensitive to. Mortgage purchase applications, interesting, because we have just a red hot housing market, right? But and these are still not; these aren't terrible levels, but we're really kind of breaking down. We got a real downtrend. Lower lows, lower highs, and the rate of change has really been consistently getting lower and lower and lower. So we know there's lack of supply, lack of inventory, and we know interest rates have been going up a bit of late. So this makes some sense. I don't think we need to worry that much about the housing market right here, but I also believe we should be paying attention to these incredible price increases that we've had, and the lack of inventory and so on. And just rampant optimism. There was an article in the Wall Street Journal this week that talked about the potential for a new housing bubble. We'll see. We certainly don't have the stress in the mortgage securities market like we used to back in here, coincidentally, when we had this disaster. But we have had, and by the way, this is the home builder confidence. It's the housing index. 82 is still really high, but again, we got to look at things on a trend basis, and we've got to look at things on a rate of change basis. So what are they complaining about? Incredibly high input costs. I wrote here a few weeks ago about the fact that on average, they say, $24,000 is the additional cost of just the lumber in a home right now. So first-time home buyers are kind of out of luck. And I hear people say, well, interest rates are so low. I get it. They're rising a little bit. But housing prices unequivocally at this juncture have risen faster than mortgage rates have dropped, or I should say the rise in housing prices has more than offset the dip in interest rates as it relates to the first-time homebuyer's ability to get out there and get a home. Okay, the Institute for Supply Management, ISM surveys, really, really important indicators of the economy. I mentioned this a second ago. The manufacturing index, wow, 64.7, and that's month over month. It's not like year over year. Some people really get this thing confused. It surprises me. So that just means the outlook versus this time last month, right? You can see that last month's services had actually declined, but that'll come out next week, and I suspect you'll see a big jump in services with the reopening of the economy. So this is an unambiguous positive going forward, and it's big. So, but remember what I said about bottlenecks and so forth. If the prices of things, if inflation continues to rise and that continues to push bond yields higher, well, as I've been writing a lot, that has been somewhat problematic, particularly for the growth stocks like tech stocks. They are what we call long duration stocks. Now, not quite so much the last week or so trading session. So we'll see if that negative correlation continues, meaning tech stocks down when interest rates are up. I think this next week after today's big jobs number, that there may be a real test of that. Okay. Just a few other things that are worth looking at that didn't give us a score change. And truck tonnage, that's just kind of a surprising drop. But I bet you could probably correlate that line with stimulus checks, right? People order stuff on Amazon, trucks in terms of the weight of what they are shipping. Of course, that goes up a ton when the stimulus goes up. And of course, it begs that question that I keep asking: what happens if all this free money ends up stopping? One indicator I really, really like is what I'll call the ratio between leading indicators and coincident indicators. What are leading indicators? They are over here: average hours worked, weekly jobless claims, new orders in manufacturing, the ISM manufacturing new orders, two different places. This would be from durable goods. This would be from the Institute for Supply Management. Capital goods orders, right? The stuff that businesses buy to improve or increase their capacity. Building permits, residential. Stock prices, right? That's of course helping this index. Money supply, right? How much cash is sloshing around in short-term places. The yield curve, when it's sloped up, longer rates go higher. That's a positive look in terms of optimism for the economy going forward. And then consumer sentiment, which we just talked about. All of these lead the economy. So you look at these in the aggregate and you say, well, what does this say about the prospects for the economy going forward? Coincident indicators, right? That's just what's happening right now, right? So non-farm payrolls came out today, 900 and some odd thousand against 600 and some odd thousand. Anticipated huge jobs number today. But that was not today, it was last month. It's what's happening right now. You would argue it's actually a lagging indicator. Personal income, less transfer payments. What are transfer payments? That's stimulus and unemployment payments. So personal income. How much money are people making? Industrial production, what's being produced right now, and then manufacturing sales, right? Not new orders, but actual sales. Basically, in the books kind of thing. So there's four of those. So coincidence says what's going on right now. Leading says what is likely to go on going forward. So we look for things, right? And we looked at this for these last few years between recessions here on the video and on the blog. And when that begins to roll over, that's a real ominous sign for the economy. See, typically it rolls over and ball game's over a few months later, maybe a year or two later. Rolls over, ball game over. This one, we kept seeing it roll over. We kept seeing it roll over. And I remember right here on the video saying, folks, 3 times, I don't think so. And this was consistent with our own macro assessment. This is when we started hedging portfolios again right in here. And sure enough, it rolled over and then COVID happened. So I think we were due for a recession, maybe not last year. Anyway, the look right here is pretty darn good. That is leading indicators outperforming coincident indicators, right? And then here's just a look at the two. The green is the leading, the purple is the coincident, right? You see the leading kind of rolling over before the coincident does, yeah, definitely in many places. Kind of odd here though, you've got the leading going up and the coincident actually rolling over pretty noticeably, right? Folks, this is just the weirdness of the stimulus. Really, 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 again, I can't, ponder that question enough. What happens if we stop giving everybody extra unemployment and stimulus checks every few months, right? And I have my thoughts, but we'll continue to crunch those ideas and the data as we go forward. Um, Inflation expectations, right? The TIPS, Treasury Inflation Protected Securities, yield on those versus the yield on the nominal bond, just the regular old Treasury bond. Now, again, the Fed says, basically, if you listen to the Fed, it's just all about what's convenient, right? They'll tell you that inflation growth is transient, right? Meaning it's only here because of COVID and bottlenecks and this and that. Well, that's convenient because they are desperate to seemingly never raise interest rates again, right? But then when the employment numbers get better, right, which says, maybe we do need to start thinking about rising inflation because of rising employment costs, blah, blah, blah. But that would be very inconvenient. So what do they say? It's much, much worse under the surface, and it is. But it's just, I've been watching the Fed my entire 36-year career, and I'll say the headline commentary is very much, very often, certainly from 2019 to now, at odds with what their own economists are writing on their quarterly reports, which probably nobody reads, but other than weird folks like yours truly. So what this does is this gives you expectations, right? So on a 10-year basis, we got 2.35%. That's the white one. 5-year and 2-year inflation expectation is 2.7%. That's pretty hot. Now, what the Fed has said, we're going to let it run hot for a while. They're already behind the curve. So if this means higher yields, which it has meant, we've seen a huge run up in Treasury yields. And we've seen, again, just to use stocks, tech stocks come down in response to that. But remember, folks, we have got a mammoth amount of public and private sector debt, particularly on corporate balance sheets. The world over has something like $300 trillion worth of debt, and like 15 trillion right now on emerging market corporation balance sheets, which I talk about a lot. So rising interest rates, a rising dollar, which could go with that, are just hell to what the Fed needs to accomplish. So if they need to, like in the 1940s, I've written about that, they'll go out and they'll purposely print an unlimited amount of money and buy bonds, push the prices up and yields down if this keeps up. That's called yield curve control. If or when that happens, stocks will probably ramp up hugely for a while, particularly tech stocks, but so will gold, right? So will miners, so will our commodities exposure. So, the question will be, and is going forward, what do we want to be in? Do we want to be in something that's just been going up like a rocket, save for that one dip last year, right? Messed up the dip. Or how about commodities, which have been doing this for the same time period, and do really, really well when the dollar is really, really low, right? Commodities will do well in that scenario. And when real yields are suppressed, meaning they're keeping a lid on the nominal yield and inflation is rising, right? When you minus inflation from that, you get lower real yields. And that's what gold has been trading on. Gold's been in a really kind of a correction phase here of late. And we had a pretty good run up for quite some time. I like it right here. I won't show you the chart because then I'm going to not be able to keep my promise. I've already gone over more than I expected. But anyway, so I like our allocation here. Okay, so getting close. Speaking of the dollar, yeah, a lot of dollar bulls out there. I get it. I'm not one, right? I did, by the way, clients who really pay attention to what we're saying, we called this on the nose, right? I was pointing here to, downward sloping wedge and the positive bullish divergence here, right? We got oversold right in here, right? We got oversold, and sure enough, look when we, you get oversold, right? That's just a relative strength index below 30. Sometimes you get a bounce. Same thing when you get overbought, right? Right here, right? Got overbought, right? Got overbought, right? So real close to it here, rising wedge, uh, beginning to diverge here on the MACD, diverging here on the RSI. I think the dollar is ripe for a sell-off. I could absolutely be wrong. If I'm right, stocks will like it, and commodities will like it, right? And we're in both. Foreign stocks will like it, and we're as much in foreign stocks as we are U.S. stocks. So if there's been a drag on our portfolio lately, it's the commodities, but the setup is very, very good. There's nothing in me that says we need to worry about that exposure. Just a little bit more dialed up, really just more in commentary. So I mentioned the jobs number. So 916,000 was what we got in March. Amazing. 660 was the consensus estimate. The revision for the prior 2 months was 156,000. So basically, folks, over the last 3 months, 1,072,000 jobs. That's amazing, right? And the work week expanded to 34.9 hours from 34.6. That's notable, believe it or not. Unemployment rate dipped to 6% from 6.2. We were at 14.8% last April, which is like a depression, right? But it was 3.5% before the crisis hit. The real jobless rate, the U6, which includes part-time people who don't want to be part-time and so forth, it dropped to 10.7%. That's not bad. And the increase was, it was where you'd expect. Leisure, hospitality, 280,000 jobs. Education and health, 101. Retail, 23,000. State and local governments, 129,000. Factory payrolls jumped by 53. Construction, 110,000 jobs. Financial sector, 16,000 jobs, and so forth. Of course, nothing ever is perfect, right? The people who have been unemployed for more than 27 weeks. That rose by 70,000. That's 4.2 million people have been out of work for more than 27 weeks. So we've recouped 62% of the jobs that we've lost since the pandemic. That means we're still 8.4 million jobs shy of where we were before COVID, right? And I think it's like 4 or 5 million jobs, folks, are permanent, meaning companies that have gone out of business that are never coming back. At the current rate so far, which is just really stepped up in 2021, it would take just shy of 2 years to get all the jobs back. So let me just close with this. You know where the stock market is, all-time highs for you. We still have 8.4 million jobs, less than we did before COVID. We have, I mentioned, 30 trillion of federal government debt. We have 10 plus trillion of corporate debt. Got a bunch, on the consumer balance sheet. Not the consumer's healthier than he and she was in 2008. We have literally a 1930s style debt to interest rate setup. We do not have, as Wall Street would tell you, a roaring 20s setup coming forward. It just is not the case. We had a Spanish flu in 1918 and we came out of it strong. Interest rates were a lot higher then coming out of that. Debt was a lot lower. You had a really good setup there. By the time we got to 1930, that relationship looks like it does now, only it's worse now. Also, this last recession, as I showed you on the blog area, was just really weird historically. Things went up that always go down, and this was the deepest recession since the Great Depression. So just a lot of distortions out there. My take is I know what the Fed and the government is going to try to accomplish, and I know exactly how they're going to try to accomplish that. And while our portfolio will see some volatility, no ifs, ands, or buts about it, will underperform the broader stock market as long as everybody continues to just pour their money into stocks. But fundamentally, being in things like miners stocks instead of Facebook, right? Miners are lean, mean, and making money. No ifs, ands, or buts about it. And that would be across the board, including gold. Materials, industrials, stocks. Green energy things, as I've been talking about, we've added quite a bit of exposure relative to the zero where we were, say, 2 years ago. So we like all that. And we're still hedging against major downside risk with put options. When I test portfolios to the downside and I show a sell-off like in 2008 or a 2000, we mitigate a lot of that by using our option strategies. We're exploring other ones. We think there's opportunity in treasuries right now because of what we think has to happen. So we may be able to diversify our hedging a little bit, leveraging against TLT, the long-term Treasury bond index, which will give us the opportunity for some added growth, even when stocks are doing well, but also some real protection when stocks aren't. So that we're just kind of putting together and running our tests and everything on. So in the next week or so, you may see some added hedge that could give us some nice potential, but without spending enough to be real detrimental, if things just continue to move in the direction they are. Went a lot longer than I expected, but thank you, as always, for watching and listening, and I'll talk to you again soon. Happy Easter, everybody. Bye-bye.